Good morning, all.
Good morning.
Hope you can see my screen.
Yes.
Yes, sir.
Good. We want to continue from where we stopped in the last class, where we were discussing disposal of chargeable of qualifying capital expenditure. You remember in our last class, qualifying capital expenditure will look where dispose or sell our assets. Well, our assets. That is what we do. So in that regard, we said we have disposed their tax and capital expenditure. One of the implication of that is that the taxpayer might need to be surrendered tax on the profits arising from the disposal of the qualifying capital expenditure. Having said that, you also said,
That's no, I give me help.
please mute your mic. Please mute your mic. Everybody. We also said in tax, especially under companies income tax, profit on disposal of qualifying capital expenditure is not taxable. Profit on disposal is not taxable. So if that is the case, we now said there is a concept introduced that is called balancing adjustments. In balancing adjustments, this is divided into two, where we have balancing charge and balancing allowance. Last class, the balancing charge will arise in a situation where your sales proceed is greater than your tax nominal value at disposal. Now, that at every point in time, there is restriction and charge. We said at every point in time, balancing charge shall not be more than total allowance of the assets that is in allowance, which of balancing charge, where we said audio is poor. Can you guys hear me clearly, please? Can you guys hear me?
No, you are breaking seriously.
Really? Okay. Let me change my internet. Also, hold on, guys. Let me change the internet. Is this better?
Yes, it's better.
Okay, I've changed the internet. So as I was saying, I said for balancing allowance is a situation where your sales proceed is less than taxing down value at disposal. So if that is the case, we said there is no restriction of balancing allowance. Why? Because we said it is an additional allowance claimable by the taxpayer. Okay. So in my last class with you, I remember we did some computation where I explained to you the implication of balancing charge and balancing allowance. So I said, let us assume SP is 100K. Taxing down value at disposal is 20K. Cost price, let's say, is 85K. Now said, compute your balancing charge from this scenario. Now said, compute your balancing charge from this scenario. How do we go about that? In doing that, from what I've explained to you so far, I said balancing charge will arise where your SP is greater than your taxing down value at disposal. So let's go. So my SP is 100K. My taxing down value is 20K. And my balance charge will be 80K. You remember, we now said balancing charge cannot be more than total allowance claimed on the assets. How do we get the total allowance claimed on the assets? We said to get that, you will say total cost minus taxing down value at disposal. So what is my total cost? TC is 85. Taxing down value at disposal is 20. Total allowance claimed on the assets will be 65. We now compare these two. We take the lower of the two. So the lower of the two now is 65. Therefore, the balancing charge shall be restricted to total allowance claimed on the assets, which is 65K. The question will now come to your mind that what would happen to the difference between this 80K and the 65K? Does it mean that the tax authority is not going to subject the variance to tax? My answer to you that day, I said no. This variance shall be subject to tax under capital gains tax. What is your capital gains tax? Please, can I see the white marker board? Are you not seeing the board? Hello, guys.
We can't see the board, it's too small. Yeah, we need to zoom in.
What about this? Can you see it now?
No.
Okay, hold on.
Yes, I can see.
Some people say they cannot see you. Let's open it again. Can you see this board now?
Yes, we can.
Hello?
Yes.
We can all see it clearly.
Yes.
Good. Thank you. Thank you. So, as I was saying, I said the difference between this balancing chart that we got, please mute your mic, and the restriction, which is 65. I said, what would happen to it? I said it will be subject to tax under capital gains tax. What does that mean? In your capital gains tax, you remember, you will always say, for capital gains to arise, your sales proceed or consideration receipt shall be greater than cost of acquisition. Abi, if that is the case, in this scenario, what is our sales proceed? Our SP is 100. Our cost of acquisition is 85. Variance, 15,000. This is our capital gains, right? Which is the same thing as the variance between the restriction between the balancing charge and the total allowance claim. You remember? So that means this variance that you are seeing here will be subject to tax under capital gains tax, while D65 shall be subject to tax under company's income tax. Do you understand what I'm saying? Do you understand it?
Yes.
Okay, good. I want to assume we all understand it. So I now also went straight that day to balancing allowance, where I told you that balancing allowance is where your sales proceed is less than your tax nominal value at disposal. If that is the case, let us also assume our SP is 100, tax nominal value at disposal is 150, sales cost price is, let's say, 250. So in this regard, SP is 100, tax nominal value is 150. Variance will be balancing allowance, which is 50. So we said balancing allowance is an additional allowance that the taxpayer will claim. So there is no restriction to balancing allowance. Now, having understood this, we quickly need to talk about general restriction of capital allowance. Basically, we are going to be looking at two sectors. Sector one is trading company. Section 2 will be agricultural companies and manufacturing companies. Okay, for trading company, the capital allowance is restricted to 66 to 30% of accessible profit. For trading company, the capital allowance is restricted to what? 66 to 30% of accessible profit. Meanwhile, for both agricultural and manufacturing business, there is no restriction. There is no restriction to the capital allowance claimable. By implication, they can claim everything. They can claim everything. So this 66 to 30% is also the same thing as 2/3 of accessible profits. So under examination condition, do not disturb yourself. Sir, okay, Busayo, do you have any question?
Yeah, the board is still showing the whole calculation. I don't know if it is from my hand or it's general.
Okay. You are not seeing what I'm writing.
Scroll
No, sir.
down. I had to scroll down my own too for me to continue.
Oh, okay.
Scroll down. Scroll down. We are moving.
Okay.
It's
Okay,
an
okay. Thank
interactive
you.
board.
I can
Yeah.
see it.
Okay. Yeah, sorry about that. We are all learning how to use this board. I just went to buy a pen. So please learn with me as I'm learning. Okay? Okay, let's go ahead. So as I was saying, I said for agricultural businesses, there is no restriction. For manufacturing businesses, there is no restriction. Meanwhile, for trading organization, there is restriction to capital allowance. Another thing that you need to know is the tax implication of capital allowance on cessation. When a company ceases operation, the company shall be allowed to be able to carry backward its capital allowance for a maximum period. Carry backward. It's unrecouped capital allowance for a maximum period of 5 years before cessation. Do you understand? So they have rights to carry backward their capital allowance for a maximum of what? 5 years before cessation. That is what the act says. Okay? So I hope you are noting all these things that we are talking about. They are very important. So if that is the case, we can move on to the next one. So let's look at our illustration in your study pack. Let's look at illustration in your study pack. Okay. From so go to your study pack and help us read Martins Limited. Can you see my board? I'm sharing something. Can you see it?
Yes.
Good, thank you. So let's talk about this. Okay. So Martins PLC. Martins PLC ceased trading in 2022. Okay. Ceased trading in 2022. With the following information. So they said Martin PLC ceased trading in 2022, year of assessment. During the review of the income tax and capital allowances computation for the year of cessation, it was discovered that the company has unabsorbed capital allowance of 1,250,000 on the date of cessation. The spread of the total profit for the 5 years before cessation is stated below. You are given. So you remember, I said where a taxpayer has a capital allowance that has not been fully recouped, the taxpayer can go back 5 years before cessation to recoup it or to relieve it against its profit. So what do we do? The first thing that we are going to be looking at is the guy has 150,000, 1,250,000 as capital allowance that has not been recouped. Capital allowance that has not been recouped is 150,000. Okay, 1,250,000. But where can this guy recoup it? The guy can recoup it against his total profit. Can recoup it against his total profit. So look at the profit that the guy has. The guy has, before the year of session is 2022. In year 2021, he has 112,500. So the first thing the guy will do is to say, my unrelieved capital allowance, which is this guy, capital allowance that has not been able to relieve, total profit. How much is total profit? I have 112,500. I'll take it out from it. I'll carry it back. So I'll say this is year 1, year 2. I'll go to my year 2. In my year 2, can you see this outside board? In my year 2, what is my balance carry forward? Backward, rather. I will have 1. 1 okay. I only write on the surface of the board. So my year 2, I will have a balance of 1. Hope you are following me, please. 1,137,500. That's what I will have in my year 2. Meanwhile, I still have this as carry backward. So what is the profit that I made again in year 2? I don't have any profits. So there won't be capital allowance recouped in this year. There won't be capital allowance recouped this year. So I will just say dash. No capital allowance recouped. So carry backward. I'll see carry backward this guy. So year 3, the guy made a profit. When you carry backward to the profit that the guy made, he made 322,500. Balance 815,100. That is the balance. So this is my year 4 now. In my year 4, the guy made a profit of nothing. There is no profit. So I'll say dash. The guy did not make any profit. But in my year 5, there was a profit of 750. That was a profit of 750 the guy made 750. So year 5 now, my brought forward is 815,000. But this guy made a profit of 750. Balance carry backward will be 65. The implication of this 65 is that it will become lapse because the act only talks about 5 years. So we have done year 1, year 2 there was nothing, year 3 there was something, year 4 there was nothing. But in year 5, you have 750 to recoup. Okay, so the balance of 65K that we have here will become lapse because you cannot take advantage of that situation again. Now let's look at this from. Hello, sorry about that. Your phone call came in and distracted my class. Sorry. Okay. So I said, let's look at this table. What I've explained so far is the same thing as this table. Can you hear me, please?
Yes, I can.
We can.
Okay. So from what I said the other time, the Act permits that a taxpayer can recoup its own recoupable or the capital allowance the taxpayer has not been able to recoup against the profits. Okay, so the profit of the guy, the capital allowance that the guy was not able to recoup before was $1,250,000. Abi, so he was not able to recover 1,250,000. So we now said, for capital allowance purpose, we can carry backward the unrelievable parts against the profit. So the capital allowance that was not recovered before was this, Fabi. And when it carried it backward, you remember the year of cessation was 2022. So when this guy carried it backward, he will carry it backward against the profit. He will carry it backward against the profit. The profit, the first profit was what? 112,500 against the capital allowance. So invariably, what I am doing in this table is just saying 1,250,000. My capital allowance I have not been able to recover. I carry backward to year 2021 against the total profit. And the total profit is 11250. So year 2, balance. The balance was this guy, which is 1,137,500. Okay. In year 2, which is year 2020, carry backward. There was no profit. Abi? So total profit, nothing. Carry backward again. 1,137,500. In year 3, total profit. The total profit we have here was this guy. So I'll take 322,500, which is the same thing as what we have here. And the balance is 81,500. Do you understand what I'm doing? Which is year 4. In year 4, there was no profit. So nothing. Total profit, nothing. Carry backward again, 815. Year 5, which is the last year, total profit, 750. Balance that cannot be recovered again, 65. Why is the balance not being able to recover again? Because the act already specified that the maximum period that you can relieve your capital allowance is 5 years before cessation. So we go back 5 years. That was why we are not going to be able to recover this 65,000. Do you have any question? Any question? Okay. In the absence of none, that means we all understand carry backward of capital allowance or cessation. Okay. If that is the case, we move on to the next question. Move on to the next question. Question number 12. Aisha shifts. Question number 12. Aisha shifts. Someone should read for us. Someone should read for us.
Okay, let me do that, sir. Aisha Shift Nigeria Limited commenced business as a trading company on 1st April 2023. The results of the company for the first 5 years of commencement of business were as follows. All figures are assumed to be correct. Please scroll up, sir. Required compute the capital allowance claimable by the company for all the relevant years of assessment. Compute the balancing charge or allowance, if any. Compute the tax liability payable by the company for the relevant years of assessment. If the company is a manufacturing company, will answer be different to what you have in one above?
So in this question is a commencement question. Okay. And it's very important that in commencement question, you have to follow all the commencement rule in attempting the question. Okay, in doing that, the first thing we would have to do is to look at the assets and see when it was acquired. Okay, so in this regard, you remember in our first class when we did capital allowance, I said any asset acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement, right? And don't forget that this company commenced when? The company commenced 1st of April, 2023. Abi? 1st of April, 2023. And they acquired an asset prior to that date. They acquired an asset on 1 They acquired an asset on 1/2/2023. And the date of commencement was when was the date of commencement? 1/4/2023. So, and from our principle, we had said any asset acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement. Therefore, the industrial building that was acquired on 1/2/2023 will be deemed to have been acquired on 1/4/2023. I want to switch this to wipe and cardboard so that we can use the wipe and cardboard to solve the question. Although we already have the solution, but I still want to. Are you there? Can anyone hear me?
Yes, we can hear you.
Okay. Let's continue. So let's solve the question. It's an angle. Okay. So they said the company commenced operation on 1/4. This is an angle. 1/4/2023. So what we need to do first is to prepare our asset allocation schedule. What we need to do first is to prepare
We don't have your whiteboard on our screen yet.
Hello.
I can't see the whiteboard.
We don't have your whiteboard on our screen yet.
Okay, you will see it soon. Hello. Yeah. Okay. I want to go out of this meeting and come back again. The board is frozen. Okay, I'm here. So as I was saying, I said the company commenced operation on 1/12/2023. Okay, and prepares its accounts to when 30th September annually. And prepares its account to 30th September annually. So the first thing we need to do is to do our asset allocation schedule for these assets. But in doing that, we must use our commencement rule. So I will say, how do I know the number of relevant years? The examiner already told us. Have they? No, they did not. So the relevant year that you're going to be preparing for will be based on your profits. Now look at your profits. Your profit ended when? 2027. That means if you're going to be preparing your accounts, it has to be from the commencement date to 2028. I mean, because we usually prepare on what? Preceding year basis. So I'll say computation of asset allocation schedule or preparation of asset allocation schedule for 2024 to 2028. Why are we using 2024? You remember that this company just commenced operation. So the date of commencement is this date. And we said when a company commences operation, the company will be assessed with tax from the date of commencement to 31st, to the first accounting year end. The first accounting year end in this company is 31st, is 30th September. That is the accounting year end of this company, Abby. So if the company commenced operation 1/4/2023 and wants to assess the company to tax based on commencement rule, would have said from the date of commencement 1/4/2023 to 30th 9/2023. And this period shall be assessed to tax on preceding year basis, that is in 2024. In the last year, I will have 1/10 rather 2026 to 30/9/2027. And this shall be assessed to tax in 2028. Do you understand? That's how we got these dates. So we go to our asset allocation schedule. We write our date out. When the company commences operation, we say the company will be assessed to tax from the date of commencement to the end of the accounting year, which is this. We said again, We said again that when a company commenced operation, such a company from the beginning of the accounting year end to the second accounting year end. I want to continue from my marker board because I'm not able to do what I'm supposed to do in this one. Sorry, guys. Okay, where are you?
I'm on Adeyemo Alakija and I'm where the map brought me to, but I can't find the place.
Look for King's College Annex, GTB head office. In front of GTB head office.
Not opposite GT Bank.
Opposite GTB head office. That is where the school is.
All right, thank you.
So we are saying that the company will be assessed to start from the date of commencement to the end of the accounting year. So let's do our asset allocation schedule. So I will say declaration. Who is that? Please mute your mic. Of assets allocation schedule. That person should mute his mic now for 2024 to 2028 years of assessments. So I'll say tax years, basis period, and QC. Please, that person, mute your mic now. So let's go. In 2024, I will have my base period to be 1/4/2023 to the end of the accounting year end, 30/9/2023. Second one will be a day immediately after the end of the accounting year end, 1/3/2023 to 30/9/2024. The next one, which is 2026, will be 1/10/2024 to 29/2025. 2027 will be 1/10/2025 to 39/2026. 2028 will be 1/10/2026 to 39/2027. Okay. Then we will now continue. We'll continue. We will now look at the assets when it was acquired. When was the date of acquisition of the assets? The first asset. The first asset was acquired a month before the date of commencement, right? So we now said any asset acquired prior to the date of commencement will be introduced to the date of commencement, Abi. So industrial building will be assumed it has been acquired on the date of commencement. So industrial building. So, and that will fall in this period. So I'll say industrial building was the first one. The next one was plant and machinery that was acquired on 1/4. So that falls within this period. I'll introduce that, plant and machinery 1. The next one was 4/7/2024, furniture and fitting. Will that one fall here? No. 4/7/2024, it will fall in this second period. Abi? I am not connected to white marker board. Is this the case for everybody?
No, sir.
No, I'm connected.
Okay, thank you. Please look for solution on that person. The next one is furniture and fitting. The next one, we acquired our assets 7/7/2025. 7/7/2025, it will fall here in this third one. That is for plant and machinery 2. The next one is motor vehicle that was acquired 10/7/2025. 10/7/2025. 10/7/2025. It will fall here. It will fall in this period too, 2026. Abi? Motor vehicle. Now, when you look at the additional information, they told us that industrial building was sold on 4th of August 2025 for 18 million. Abi? So 4th of August 2025 will also fall in 2026. So industrial building disposal. So that is that. So this is our asset allocation schedule. Now that we know when the assets has been acquired and when they were acquired, so we move on to the computation of our capital allowance. Computation of capital allowance. So I will say, what is the name of this company? Aisha Shifts. Computation of capital allowance for 2024 to 2028 year of assessment. How many assets did we buy? We buy about 5. plant and machinery 1, 2, industrial building 3, and motor vehicle 4, and plant furniture and fitting 5. So we bring them in one after the other. You can actually merge 2 assets together. Okay? But if it is going to confuse you, don't do that under examination condition. So I'm not going to merge the assets. So QC rates. So the first QC that we acquired in this question is motor vehicle industrial building. So I bring industrial building. The rate of industrial building is 15% for initial allowance, and annual allowance is 10%. For plant and machinery 1, initial allowance is 50%, annual allowance 25%. The next one, we bought motor furniture and fitting. The examiner will give you this table, so don't give you the rates rather. So it's 25% and 20%. We bought motor vehicle 50% and 25%. So plant and machinery 2, 50% and 25%. So here will be capital allowance. Okay. Come on, close it door. So I'll start with the first one. You remember that the first one was 2024, and our basis period then was 1/4/2023 to 30/9/2023. Now, this is not up to 12 months. So I'll put costs. What is my cost of acquisition of this asset? I acquired this asset for 12,000,760. I also acquired the other one, 4,000,009. I didn't acquire anyone based on our assets allocation. You can see that we only acquired 2 in this year, and those 2 were the ones that I brought in here. Okay, so on these 2 that I acquired, I will have initial allowance. 15% of this will give me what? 15% of industrial building will give me 1,800,114. 50% of the motor vehicle, plant and machinery will give me 2,495. You see these 2? I will now add them together. I'll bring them to capital allowance column, which is 4,295,114. The next one is to calculate by annual allowance. But I'll show my working somewhere else. Annual allowance is cost minus initial allowance, Abi, divided by N. Abi, are you following?
Yes.
Good, thank you. So for industrial building, the asset cost us 12,000,00760, and we have an initial allowance of 1,800,114 divided by. Now, in this our situation, the company does not have, is not, did not operate for 12 months. Therefore, we said if our base bill is not 12 months, we prorate our annual allowance. So before we go, let me quickly remind you of something that we did in the last class. I told you to get your N, you will say 100% divided by annual allowance rate. Okay? And Y is where the basis period is less than 12 months. Okay? So, we'll go. AA is equal to 12,000,760 minus 18114 divided by N in building. Building has 10% as annual allowance. That will be 100/10. That will be 10 years. 10 years multiplied by how many months do we have in this basis period? From April, May, June, July, August, September. 1, 2, 3, 4, 5, 6. So that is 6 months. So multiply by 6/12. Whatever you have is your annual allowance. For this case, it is this value. AA for plant and machinery, 1. The same thing, cost minus initial allowance. Our cost is 4,990 minus 2,490. This asset is supposed to use 4 years. How? The annual allowance rate is 25%. So if I say 100 divided by 25, I will have 4 years. So it will use 4 years. Multiplied by 6/12. We have 311,875. So that's how we got that. Any question? Any question? Okay, so I bring the values that I calculated. Same here. How we had. So in 2025, which is full basis period now, which is 110 rather, 2023 to 39/24. My tax now value. That is this minus this minus this. I have 9,690,614. For this one, I have 2,183,125. Now, did we acquire any asset this year? We did. We acquired motor furniture and fitting. I will bring in that one. Furniture and fitting was acquired for 2.4 million. $2.4 million. On the new one I just acquired, I will calculate initial allowance on it. So my initial allowance rate is 25%. 25% of 600 is 6 of what was it called, of 2.4 is 600,000. We don't have any assets here again, so the total allowance for me this year will be 600,000. So move on. We need to calculate our AA. AA. Now, for our AA, so I was saying that you have to be very careful in applying the capital allowance, especially when the assets, you have prorated it in the first year. So in the second year, you have to also try to remove the proration. So and I said, for my annual allowance for industrial building, I will need to recalculate it in the second year. This time around, I am not going to prorate it. The same thing for annual allowance of plants and machinery 1. I will not prorate it in this period. So whatever I have will be my answer. Therefore, so what do I have? In the first one, AA, I have 10206,065. For furniture and for plant and machinery, I have 623,750. Now on this new one that I just acquired, that is furniture and fitting.
So I think you mixed both of them.
Huh?
I think you mix the annual allowance for industrial buildings and furniture and fittings. So you need to interchange it.
That's true. Thank you. Okay. So this is supposed to be this is supposed to be so what's the tax return value of this? We've not even written it down. We have 9,690,614. Annual allowance of that will be 1, Abby.
Annual allowance for this industrial building is 623,750. Something is wrong with this.
How did you get that? This minus this divided by 10. What will you have? Do you understand what I'm saying?
Yes,
This value.
Mm-hmm.
You've seen it. Okay.
Mm-hmm.
So this guy was 2.4. So annual allowance for furniture and fitting. Furniture and fitting. 2.4 million minus 600,000. This asset will use 5 years. Give me, someone is asking question. So I started from the cost, Abiola. The cost, the reason why we are doing that is because in this second year, the asset has 12 months. Okay, so we need to recalculate it. Let's go ahead. So give me my value. That will be 360. I will now add the three together. This plus this plus this. I'll bring it to my total column. So I have 2,003,815. The next one in 2026, 110, 2023, 4 to 39, 2025. Now, tax return value. The tax return value for industrial building is 8 million. 8,670,549. Abi, tax return for this guy is 1,455,417. Tax return value for this guy is 1,440. Now, we disposed the industrial building. So because we have disposed industrial building, we need to take it out from our books. Okay. So in doing that, I'll say I'll just take out the entire value. We did not dispose any other assets. The other asset we did not dispose, we calculate annual allowance for them. Remember, annual allowance is constant. But it's like we acquire additional asset this period, Abi. We acquired additional assets. So let's bring in the asset that we acquired. Addition or cost. We didn't acquire for this guy. Cost. There was no acquisition for this guy, none for this guy, none for this guy. But for motor vehicle, we acquired motor vehicle. Look at it. And plant and machinery 2. The first one was 10 million. The second one was 5 million. On the new acquisition,
Sir,
you need to calculate your
sorry, your value for plant and machinery, I don't think it's correct. It's supposed to be 1,559,000.
what is supposed to be.
If we're subtracting 2,183 from 623, it's supposed to be 1,559.
Are you sure?
Yes.
Yes, sir.
So what do you have?
155 9375 937.
What is it again?
1,559,375.
Okay. So on this new one, we need to calculate our initial allowance, have we? So initial allowance for motor vehicle is 50%. So this guy will be 55 million. And this guy will be 2.5 million. Abi? Addition of the two, 7.5 million. AA. There won't be AA for the asset that we have disposed, but there will be AA for motor vehicle because we said for plant and machinery 1. And there will be AA for this guy. On the new acquisition, we need to go and calculate our AA. Plant and machinery 2. Cost 10 million. Minus 5 million, which is our initial allowance, divided by 4 years. The next one is motor vehicle. 5 million. Minus 2.5 million. Abi? Divided by 4 years. Whatever you have, we'll bring it in. For motor vehicle, I have 1,250,000. And for the other one, I have 625. So we add the four together, that is this plus this plus this plus this. What would we have? We would have 2,850,000 5,8,750. Confirm. Confirm. Now, disposal. We have disposed the industrial building. So I'll take it out. So I didn't dispose any other one. So firstly, I need to get my tax renown value and my total allowance for that year. So what's my tax renown value in 2027? I will have nothing for building. I have disposed it. What will I have for my, what's it called? For the plant and machinery one. What's the balance?
$935,625.
935.
625.
What will I have for my other one? 10. Abby. What will I have for this guy? And this one will be 187. We are not done. In 2027, we did not acquire any assets. So I will have my annual allowance. For building, we have disposed building. There won't be annual allowance for building. However, you see this plant and machinery as used year 1, year 2, year 3. In the 4th year of use, I have told you, your annual allowance in the last year of use is equal to tax now value of the previous year minus 10 naira is a condition. Therefore, what was my tax now value of the previous year? 935,625. Remove 10 naira from it. You have 935,615. This is not the last year of use of this guy. So I'll still have 360. It's not the last year of this guy. I'll have 125. It's not the last year of use for this one. So I have 625. Add the 4 together. I will have 3,170. Confirm 15. So this is 3,170. So in 2028, my tax now value for building is also new. For this guy is now 10. For this one is 720. For this one is 2.5. This one is 1,250. AA. There is no AA for building. There is no AA for plant and machinery 1. There is CAA for this guy. Because this asset It's supposed to use 5 years. So year 1, year 2, year 3, year 4. So we have not gone to the last year of use. So I'll still bring my annual allowance in. The same thing for these guys. So my total allowance for that year so our tax now value, this is 10, this is nothing, this is 360, this is 1250, and this is 6250. So that is the computation of our capital allowance. Any question? If there's no question, we need to go and compute computation of balancing adjustments. Now, you remember the disposed industrial building, Abby? And they told us that they sold it for 18 million. They sold it for how much? 18 million. They sold it for 18 million. If you go back to the question, you will see that the asset was sold for 18 million. Abby? Now, at the time we are disposing the assets, we sold the assets. The terminal value of the assets was 8,640,540. Terminal value 8,640,670,540. So this will be balancing charge. You remember what we talked about balancing charge? We said balancing charge will be a situation where your sales proceed is more than your tax now value, Abi? So this will be balancing charge. How much do we have as balancing charge? 9,329,451. Abi? Now, you now remember, I told you that we need to check for total allowance claimed on the assets disposed. How do you do that? We said total costs of acquisition. In this regard, our total cost of acquisition was 12,000,750. Abi, less total allowance or less taxing down value at disposal. So how much are taxing down value at disposal? 8,607,540. Total allowance claim on the assets. is 3,330,211. If you are in doubt, let's go back to our computation. In our computation, the first allowance that was claimed on this asset was 1,800,114 plus 510,032, Abi, plus 1,020,065. That is all. So if you add these three together, we have 333,0211. Confirm that number. Is it confirmed?
Yes, sir.
Good. So that is how we got that number. Okay. So we are now saying, according to the principle I taught you today, I said your balancing charge shall not be more than the total allowance claimed on the assets. Okay. So the total allowance claimed on the assets in this scenario is now what? 3,330,211. So therefore, balancing charge shall be restricted to the total allowance claimed on the assets disposed. Do you understand? So if that is the case, we can now go ahead and compute our company income tax. Now, in any question that the examiner gives you, your first assumption is that the company is operating as a trading company, except if the examiner puts a caveat that shows that the company is a manufacturing company. If the caveat is not there, that means the company is a trading company, right? So for a trading company, your capital allowance shall be restricted to 2/3 of assessable profit. So let's go. I shall shift.
Please, can you come again with what you just said? I don't think I got it.
Okay. I said capital allowance for trading company. We have said it before. For trading company is restricted to 66 2/3% or 2/3 of assessable profit. Okay. Meanwhile, for manufacturing and agricultural businesses, there is no restriction. Do you understand me? Do you understand me?
Yes, sir.
Good. So in this question, if the examiner did not say anything about whether a company is a manufacturing company or an agricultural company, you must assume is a trading company, except if the examiner puts it there at the introduction of the question that this company is a manufacturing company or this company is an agricultural company. Therefore, you would have to restrict it. Let's go. You don't start. Oh. So let's continue. So I'll say computation of companies income tax for 2024 or 2028 years of assessment. So in 2024, from 1/4/2023, 39/2023. Accessible profits. So how much are accessible profits? Our accessible profit was 3,359,060. What's our capital allowance that was computed? Capital allowance. Our capital allowance that we computed
5117021.
511
7.
for the year.
51702.
5110
021.
leave for the year. Now this company is a trading company.
Yes.
I cannot take more than 2/3 of the accessible profit. What's 2/3 of that?
Right. So then just minutes. That will be 2,223,9,373. Wait.
Capital allowance carry forward.
Two, eight,
2
7, 647, 648. Approximately.
Sorry,
2
that's a carry forward. So you bring this guy so total profits. The difference between the two will 1119. On that, you calculate company income tax, 30%, tertiary education tax at 3% of accessible profits of total profits. So this one, 30% of this will be 3,906. 3% of this guy will be 100,772. Next one, 2025. In 2025, my base pay will be 110. 2023.
How are you?
To 39.24. So accessible profit. How much are accessible profits? 23 million.
23,908,620.
Capital allowance. Brought forward. How much are we bringing forward? 2,877
648.
for the year. You go back to your table.
2603,815.
Two 603,815. Relief for the year. Now, when we are relieving for the year, if I add these two together, it will give me in the range of 5 million. If I take 2/3 of this, it's going to be like 18 million. Therefore, we don't need to restrict the capital allowance. Do you understand what I'm saying?
No, sir, I don't understand.
Please, can you
So
say it again, please?
I am saying that the purpose of restriction is that your capital allowance should not be more than 2/3 of the accessible profit.
That's correct.
So if I take 2/3 of this guy, it is in the range of 18 million.
Okay, it's going to be more than the addition of these two.
More than, so we don't need to restrict.
All right.
So I will not restrict. Do you understand, Busola?
Crystal clear.
Do you? Busola, were you want to ask the question? Busayo, rather.
I understand, sir. It's Messi that asked the question.
Okay, okay, Mercy, how are you? Okay, so we'll go ahead. So I'll add these two together and just relieve it, which is 5,481,463. Carry forward, nothing, because there is no restriction.
Yeah.
Total profits. $18 million. 427,157. On that, I will compute my company income tax at 30%, tertiary education at 3% of accessible profit of total profits. So we go to 2026. Remember, in 2026 there was disposal. You need to take cognizance of that. One, then 2024 to 39, 25. Accessible profit. How much are accessible profits? 32 million. Now, there is a balancing charge in this period, Abby. How much is our balancing charge? Our balancing charge is 3330211. Abby? 3330211. So it's an addition. Okay? So we now also have our capital allowance. Brought forward nothing for the year. What was our capital allowance for the year? We'll go back to our table. 10 million. So I'll say 10 million 358 rather. $750. Abi, relief for the year. If I also say 2/3 of this is about 20-something million, which is more than 10 million. So I will not restrict the capital allowance. Carry forward. Nothing. Total profits. What was my total profits?
25,500,401. 50041.
537. On that, I'll calculate my SITA at 30%, and I'll calculate my education tax at 3%. So that is how to compute your allowance to the company. So this company were to be manufacturing company, the answer be different. Yes. Why? Because in this place, our capital allowance. If the fact it would, and I will show you 5 million, 1 here. Because there is no restriction, you can take the entire profits. Relief for the year. Entire profit will be taken. Like this one, carry forward. We only, and in this regard, there won't be profit. Nothing. Abi? And in that year, they will not pay tax. Do you know what I'm saying?
No, we can't hear you.
We can't see what you wrote to.
Are you there?
Yes, but we cannot see your board.
Trying to open it up. So what I'm trying to explain is that because there is no restriction, our capital allowance and our profit for the year will change. Okay, the profit will change. In that first instance, they will not pay tax because you have wiped out the profit element with your capital allowance. Where is it? Now we must see. Okay, no problem.
We can't see what you're writing.
I'm not writing. So let's go again. I was saying that if the company were to be manufacturing company, the accessible profit capital allowance for the year, you remember you have this, will leave for the year. You will not restrict it. You will take the entire profit. Carry forward now. You have 1,117. Total profit, nothing. Why are we taking this route? Because we said the company is not company, and for a manufacturing company, you don't restrict the capital allowance. So there is no total profit, and but you will still pay tertiary education tax because that is paid on accessible profit. In the second year, we see our profit to be 23 million 908,602.
I can't see what you're writing.
Capital allowance. Brought forward.
So we can't see what you're writing.
I can't see what you're writing.
You can't see my screen?
No,
What
sir.
you're writing, we can't see. We can see the board, but we cannot see what you're writing.
Okay. That will be most likely to be certain. Let me just explain what I'm saying. So, let me see. So I said for the first year, why? Because I don't know why the thing is still stressing. So, but what I'm just trying to say is that the capital allowance must be restricted for a manufacturing company. They are not going to restrict capital allowance for a manufacturing company.
So, okay, in a situation where the additional profits cannot accommodate the entire capital allowance, what happens?
So if the acceleration cannot accommodate their entire capital allowance, so what you will do is to take the total civil profits. I get all the civil profits and carry forward the balance of the capital allowance. Do you understand me?
Okay.
That's what I'm explaining.
So for that year of assessment, there will be no CIT, but there will be TET.
There will be education tax. The education tax will be on the total profits.
Okay. So there will be no CIT.
No CIT.
Okay.
So that's what I'm trying to explain. I don't know why the board is messing up, but it's fine. So that's why we start the class today. I'm going to forward you the next topic. We are moving at a very gradual pace. The next topic is companies income tax. We are going to look at the tax implication of company income tax, and we're going to solve questions in your past questions. Note carefully that for companies income tax, it's more or less like number one question in your exam. The examiner usually asks questions on companies income tax, and it's more or less like number one. So we are going to dwell on that when we meet in our next class. We ensure we treat questions like at least 4 case study on companies income tax before we say bye-bye to companies income tax. After companies income tax, I'll be looking with you hydrocarbon tax, and that will be the end of my class with you. After I'm done with hydrocarbon tax, we now do general revision. Okay? So,
all right.
To you.
All right, sir. Thank you. Have a nice day.